you got to have good books. I mean, you got to stay on top of your accounting. You got to have clean financials because that's the starting point for any sort of tax planning or projection.
Hey, welcome back to the show. I have another guest on this episode. Today I have Cody Daniels with Builders Tax Group. Cody, welcome to the show.
Brad, thanks for having me. Excited to be here.
Now, we're going to be talking about something that's really exciting for most of our listeners, and that is things about taxes and accounting.
Yeah, I don't often hear people say that it's going to be really exciting. Obviously, I think there's probably a little bit of sarcasm in there, but...
a little bit of sarcasm.
Yeah, it's important. It may not be exciting. If you're driving, I suggest maybe you pull over and take a little break so you don't fall asleep at the wheel as we get into this. If you're an entrepreneur, this is one of the most costly things that you're going to incur in your life is taxes. So it's an important thing to talk about.
Absolutely. Before we get into all of that, Cody, I want to give you a chance. Just give us a little bit of information about you, your business, maybe how you got started into accounting and tax advisory. Just give us a little bit of a blurb about you.
Yeah, so I founded Builders Tax Group in 2024 after spending the first 12 years of my career at a regional CPA firm located here in Chicagoland. Started out with that firm right out of college, spent the first 12 years of my career there. Great firm, saw tremendous growth there, but as you experience tremendous growth, things tend to change. Just overall the environment, kind of evolved, and I wanted to be able to focus all of my time on working with construction and real estate type clients, and really clients of a particular size. As they were growing, they're starting to move upstream to larger contractors. I was working on contractors doing $200+ million a year in annual revenue. And I really wanted to focus on, kind of what I consider the mom and pops, people doing maybe up to, 10, 20, $30 million annually. I kind of wanted that to be my focus. So left that firm in 2024, started Builders Tax Group. And we're a niche, specialized, expert, whatever term you want to use, firm focused on serving construction and trades businesses, providing tax, accounting, advisory, fractional CFO type services, as well as cost segregation for anybody that owns real estate in addition to their construction business.
Awesome. Sorry, I was muted for a second. No, I was joking earlier, about being exciting. The thing is, this is really important stuff that we need to know. Or maybe we don't necessarily need to know it all, but we need to know enough to be able to hire someone that can do it for us, right? So
yeah,
this isn't things where it's just I'll figure it out as I go, or I'll get my niece, who works at H&R Block to do my taxes for me and all that stuff. And it's this is really important stuff. And although, no, it's not fun and exciting and doesn't, have all the bells and whistles, it's still stuff we got to at least have a good conversation about so that we can understand some of it. In a little bit, we don't not right this second, but we're going to talk a little bit about the new bill that was passed and how some of those changes are going to impact contractors. So that's something we definitely want to get into. But before we get into that, I'm looking at your website, and you mentioned it just a while ago. What is cost segregation? Can you explain that?
Yeah, so cost segregation is it's a tax concept where anybody that owns real estate that they use in any sort of business purpose, so it could be, you own the office building that you operate out of, it could be rental properties that you rent out. So we're very clearly not talking about your personal residence, your vacation home, your fund properties, things like that. It's got to have a business purpose behind it. But what a cost segregation study can do is it will identify components of that real estate that qualify for shorter tax depreciation treatment. So under normal tax law, a residential rental property will be depreciated over 27 and a half years. A commercial property is going to be depreciated over 39 years. So if you go out and you buy, a combination office warehouse space to run your construction business out of, it's going to take you 39 years to recover the cost of that property via depreciation deductions. Through a cost segregation study, we can come in and identify components of that, such as, maybe flooring. A lot of types of flooring are going to qualify for a 5-year depreciation schedule. Things like maybe cabinetry or other furniture and fixture type items are going to be 7-year assets for tax purposes. And actually the outside of the property, the exterior of the building, your land improvements, so your landscaping, your parking lot, your sidewalks, those all qualify for like a 15-year treatment for tax purposes. So via this study, essentially what you're able to do is accelerate those tax depreciation dollars into the current year and really generate significant tax savings for yourself at the, I guess, alternative of taking 39 years or 27 and a half years to depreciate that property. And not to jump too far ahead, but because the new tax bill has reintroduced and made permanent 100% bonus depreciation, these cost segregation studies, all of those assets that you would reclassify to a shorter life are going to be eligible for 100% bonus depreciation. So it's a full write-off. It's not, oh, we're going to take our flooring and depreciate it over 5 years. No, we're going to write the whole thing off in year one. So depending on the type of the property, you could easily see 20 to 30% of that building costs being written off in the year that you acquire that building.
Wow. Okay. So yeah, that's stuff that, if you didn't even, if you didn't understand that or know that, then you're just going to think, oh, I got to get it over 39 years. And
yeah,
that's just what it is. So, I mean, that alone could be tens of thousands of dollars worth of savings, depending on what it is. But
yeah, easily. I mean, if you're somebody that's doing, investment on the side of your construction business, I mean, yeah, you could be talking hundreds of thousands of dollars of additional depreciation deductions. And depending on your situation, you may be able to use those deductions to offset income from your construction business. So yeah, very powerful opportunities out there for anyone that owns real estate right now.
All right, well, let's change gears here for a second. When you're meeting with new contracting clients or prospective clients, what is the most common thing that you see they get wrong in regards to, it can be accounting or tax, whatever that is, like accounting in general?
Yeah.
What do you see that they're doing wrong or, misunderstand about it, whatever? Like, what are those things that you normally see?
I would say the most common mistake, and we're going to probably get a little more technical here than I would necessarily like to. And you kind of hit the nail on the head early, Brad. Like, I don't expect anybody that's listening to learn this stuff and be able to do their own tax return. We just want to empower people. It's just a base level knowledge so that they can take questions to their tax preparer, their CPA, and have informed conversations and, be aware that there's opportunities out there that they should be taking advantage of. So with that little disclaimer, I think the biggest mistake that I see is misapplication or misunderstanding of the accounting methods that are available to contractors for tax purposes. So I think most contractors, especially if they're doing new construction, let's maybe focus on those types of businesses right now. If you're more of a service-based contractor, this may or may not apply to you, but especially if you're doing new construction, bigger jobs, most contractors are aware that they need to use the percentage of completion method for their books. So what that means is simply that as you incur costs on the job, you're recognizing your revenue to the extent that job is being completed. So I guess a real simple example, you have a $100,000 job. You think you're going to incur $70,000 of direct costs on that job. So you're going to have a $30,000 gross profit on that job. If at the end of the year, you have recognized $35,000 of costs, that job is 50% complete, you should recognize $50,000 of revenue on that job, irrespective of what you've billed that client. So you may have billed the client nothing. You may have no outstanding receivables, but you still need to recognize $50,000 of revenue. So that is, I think, conceptually what most contractors should be doing for book purposes, but there are a variety of other methods available for tax purposes that if you're not in tune with the construction industry from a tax perspective, like you may be missing out on opportunities there. So there are a variety of exemptions from the percentage of completion method that exist for tax purposes that would allow you to use something like a completed contract method where you defer all of your gross profit until the year that the job is done. So if you have a big job that takes 2, 3, 4 tax years to complete, instead of recognizing income throughout the life of that job, you can kick the can all the way to the year that the job is complete and defer all of that tax liability into the future. So I just see a lot of, I'm going to call them your Main Street generalist CPA firms. John Smith, who's on Main Street, got the sign out there, been there for 50 years. If they're not in tune with construction, they're not frequently looking for these opportunities to defer income and, take advantage of other methods that are available to contractors. They just kind of, they just do status quo and file the return. And, it's ultimately it's a timing difference. So you're going to pay the tax eventually, but we all know that $1 today is worth a lot more than $1 4 years from now.
Yeah. What's the benefit of doing the 50 billing out, or not billing out, but taking the 50% of the revenue in the year, even if you haven't billed them or not? What's the benefit of that?
I wouldn't really say it's even a benefit. It's just a requirement. It's just under generally accepted accounting principles. That's how contractors are required to recognize their revenue. So if you're somebody that has bank debt, or you're looking to get bonding for jobs, whoever is using your financial statements, a banker, bonding agent, etc., they're going to expect that your financials are on that percentage of completion method, because from their perspective, it's the truest representation of your income. Again, your billing practices become irrelevant at that point in time. It's really just based on what progress have you made on the job, and that is how your financial statements are presented. So, I wouldn't necessarily say it's an advantage. It's just really kind of the requirement.
Yeah, I mean, you could have completed $1 million worth of work and maybe not have collected a penny of that, but
Correct.
That's a major difference in revenue, right? In terms of
right. And that's why sorry to jump in there, but that's why for tax purposes, we want to explore other methods, right? Because what if you've collected nothing, but you do have that $1 million of revenue on the books? Well, you don't want to pay tax on the $1 million if you haven't collected any of it, right? So let's explore other methods for tax purposes. Let's get the best of both worlds, right? Let's present your financials on that percentage of completion method so that your banker or your bonding agent is happy and they can see how the jobs are progressing. But then on the tax side, let's take advantage of the methods that allow us to not pay tax on paper income, phantom income.
Yeah. Is there a size of revenue for a company where this makes more sense than not? If you have a small contractor that's only doing $500,000 a year in revenue, is it that important versus, a company doing 50 million in revenue? Obviously that would make a lot more sense.
Yeah. I mean, I think, I don't know that I have a threshold really. I think it's going to depend on what you need your financial statements for. So even if you're doing $1 million, $2 million in revenue, but you need to have good financial statements for the bank, you're probably going to want to go through that little bit of extra effort to present them on the percentage of completion method, if that's what they're requiring and expecting. So it really depends on your needs. I will say I work with a lot of smaller contractors that are probably 5 million and under, where they don't have the need to present on the percentage of completion method. So we're not going to go through, the extra effort to calculate that and complete those adjustments in their financial statements. I would say for sure, if you're over 10 million, you probably have a need out there where somebody external is utilizing your financial statements, and they're going to want to see it presented that way. I guess I'm trying to think of other examples here. I have a client, their GC probably doing 3 million on average every year. They want their financial statements on percentage of completion because they're part of a mastermind group, and part of their meetings is semi-annually they compare financial statements to each other, and they want to have it presented in a way that everybody's presenting on the same method of accounting regardless of the size of their business. And so, they're willing to spend a little bit of extra money to make sure that things are presented in that way so they can come and contribute to the mastermind group.
Yeah, that makes sense. Okay. All right. Well, let's get into some tax guides, principles, whatever you want to call them, tips, tricks. What are some tax things, just kind of a general 30,000 foot view that a contractor should employ in their business, some strategies?
Yeah. So, great question, Brad. And I have the framework for this. I could send this to you. Maybe we could link it in the show notes.
Yeah, we can put in the show notes. Yeah.
I put an ebook together at the end of 2024. It's called Laying the Foundation. It's 10 strategies for contractors to minimize their taxes. So it's 10 different chapters, 10 different topics that, contractors should look into, consider to make sure they're taking advantage of all the opportunities out there for them. I can just run through the table of contents and tell you what the different, strategies or opportunities are. Number one is you got to have good books. I mean, you got to stay on top of your accounting. You got to have clean financials because that's the starting point for any sort of tax planning or projection. If you come to me here, we're coming up on Q4 when I start doing all my annual tax planning with clients. If you come to me and say, hey, I haven't closed my books since April, I'm gonna be like, I can't do anything for you. Like I need it to be, at least kind of up to date. I need it to be, through August, September, and then we can start having a conversation, right? So I think that's kind of first and foremost. You got to have good, clean books that we can work off of. I would say from there, I think making sure your business structure is set up the right way. So your choice of entity, this is applicable to people just starting out, but I think it's also something that if you've been in business for 10, 15, 20 years, you might want to reconsider as well, because as your business has grown and evolved, that initial entity structure may not still be applicable. So, evaluating, should I be a sole proprietorship? Should I make the jump to S corporation? If I'm a C corporation, does that still make sense? I think a lot of people with the current tax law think, well, I maybe want to jump to C corporation because there's a flat 21% tax rate there. But you still have the double taxation issue to deal with as far as, taking money out of the corporation. Your dividends are subject to a double taxation there. So in a lot of cases, that may not make sense. Are you at the point in, your stage of your business where you're looking at transition, whether that's to an external party, whether that's to, your kids, employees, whatever, the structure of your entity is going to significantly impact how you might want to transition your business and, what tax benefits you may be able to obtain as you transition out of that business. So that's definitely an area I would look at. We already talked about methods. I got a whole chapter on methods in the book. Depreciation is obviously huge. That's a conversation I have with my clients every year. Do I go out and buy 3 new trucks before the end of the year or not? Right. Do I go buy this piece of equipment? Let's talk about the pros and cons of it. We'll probably get into, again, some of the new changes to accelerated depreciation under the tax bill. So there's a lot of opportunities and decisions to be made there. I think there are a lot of tax credits that are available to contractors that they may not be aware of. One that we'll probably talk about as it relates to tax law changes, research and development. I think a lot of contractors think that just because I'm in construction, I'm not eligible for things like that. That's for tech companies or pharmaceutical companies. Well, no, there's an opportunity for a lot of contractors to obtain research and development credits. There's work opportunity tax credits. If you're hiring, like veterans, for example, I have a client that's a veteran-owned contractor, and they try to hire veterans when possible. Well, there's some credits that they can generate by making those hires. Let's see what else. Other chapters in the book. Retirement planning. Retirement planning is huge. Construction is an area where there may be, I'll call them sort of non-traditional retirement plans. They can really work well for them. Something like a cash balance plan. That's more along the lines of like a traditional benefit plan, not benefit plan, sorry. A traditional pension plan, sorry. If you are a union contractor and the bulk of your employees are covered by the union retirement plan, you as the owner of that business might consider utilizing something like a cash benefit plan to sock away significant dollars that are almost exclusively for you. The only employees that would be eligible to participate in that plan are any non-union employees. So maybe like your office employees or administrative staff, things like that. So there's some huge opportunities there within retirement planning. Estate planning is definitely something that, if you're at that stage of your business, you should be thinking about. Potential ways to transition the business, potential ways if you have had a very successful business and you have a very large estate, minimizing that so that when you eventually do pass away, you're setting your heirs up for the most efficient tax outcome that they can receive. So, a lot of stuff in that book. We could probably do a whole episode on that, but
yeah. Well, those right there are actually, those are big things, right? Those are some major things that over the course of our lifetime or business can rack up to, like I said, tens, hundreds of thousands, maybe even millions of dollars worth of either savings or, fees for that matter.
Yeah.
Well, let's jump into the big, beautiful bill that just passed and some of the changes that are going to affect contractors or some advantages that you can, or some changes that you can take advantage of. I know one that you'd mentioned earlier is the bonus depreciation, or, speak a little bit about that. What does that mean? How is that going to affect contractors?
Yeah, so the One Big Beautiful Bill Act reinstated and made permanent 100% bonus depreciation. So essentially what that means is, any equipment purchases, most vehicle purchases, there are some exceptions for vehicles, but most vehicle purchases, interior build outs, and then even other elements of your building. If you're looking at that cost segregation study that we talked about earlier, there's going to be a lot of CapEx that's able to be written off 100% in the year that you make that purchase. So, and that 100% bonus not been reinstated, the previous law was a 40% bonus depreciation rate. So you can see here that we're getting another 60% write-off in year one for those types of assets. And again, it's made permanent, which means that it's just not scheduled to sunset or disappear at a future date. Obviously, a new tax law could change that, but we, in theory, have this until somebody in Congress does something to affirmatively get rid of it. It's not like the last time we had a tax bill where it was scheduled to go away. It's around until they get together and pass a law to get rid of it.
This is also, as far as like writing off these expenses, this is where you need to have a conversation with your accountant, because you may not want to write it all off in the first year, correct?
No, that's,
if you don't have very much revenue, then you don't want to take advantage of that, I'm assuming.
No, that's a great point, Brad. I don't think effective tax planning is always driving to the bottom, right? I think there are a lot of reasons why you may want to be strategic about the income that you have. You may have, carryovers of tax benefits that are expiring. So there are, again, some of these credits and net operating losses and things like that, they will expire over time. Well, if you have expiring credits, you don't want to lose out on that benefit. So you may not want to drag your income as low as possible. There may be strategic reasons to show X amount of income. You may be somebody that's trying to, go out and buy a new property, and the bank may be wanting to see income on your tax return. So it's not always, good tax planning is not always about getting the lowest possible tax liability. It's about getting what makes sense for you based on that year. And everybody's situation is different. And that's why you really should be having these conversations annually, because there may be very valid reasons to not just push it as far as you can take it.
And again, this is the argument for why you should have a professional who can help you navigate those decisions, right? So, all right, what about R&D? You spoke about that earlier. What does that mean for contractors? How does a contractor use R&D, opportunities for lowering our tax liability?
Hey, just a quick time out from the show. If you're a frustrated contractor who's dealing with low profit margins, stuck working on the tools every day, or doing free estimates for people who are never going to hire you in the first place, I invite you to my private contractor community, the Profit Club, where contractors just like you are adding 2 to 3 times more profit each year without producing any more jobs, and finally getting completely off the tools to never do another free estimate again. So if you're ready to increase your profits, stop doing free estimates, and get off the tools, then all you have to do is click the link in the show notes to learn more about the Profit Club and see how it can easily 2 to 3 times the cash in your pocket, give you a proven sales process that will convert more jobs with ease and get you off the tools once and for all. And the best part is you can do all of this without having to produce more jobs than you currently are. Click the link to learn more. Now let's get back to the show.
Yeah, so I think that there's maybe a misconception out there that contractors are not an industry where there'd be a lot of opportunities for an R&D credit because they're not, inventing new products necessarily, and they're not doing, sort of these technical like studies and things like that. But the R&D credit's a lot more expansive than I think people are aware of. So, simply like investing in new construction techniques, maybe utilizing, like new materials, even more process oriented things where like if you're focused on implementing new processes to improve efficiency on your jobs, that may be an activity that qualifies for a research and development tax credit. And these credits can be pretty significant. And it might be worth highlighting the difference between a tax credit and a tax deduction. So a tax deduction is just simply a reduction of your taxable income. And the benefit of that is achieved at whatever your tax rate is. So if you have $1,000 tax deduction, and let's say you're at a 40% overall tax rate, the benefit of that $100,000 deduction is $40,000 for tax purposes. On the flip side, a credit is a dollar for dollar reduction. So if you have a $100,000 tax credit, the benefit of that is $100,000 because it reduces your tax liability. It doesn't reduce your income. So, I worked with contractors over the years. I worked with a $200 million electrical contractor. They would, I would say on average, get about $5 million of R&D credit a year. So between the various owners of that company, there was a total $5 million reduction to their taxable income in aggregate, just from going through the process of having this study done to quantify the credits available to them. The reason I guess we're bringing this up as it relates to the One Big Beautiful Bill Act is there was for a period of years a requirement to capitalize the expenses related to R&D activities. So that kind of mitigated or lessened the benefit of an R&D tax credit that was available to you because you had to capitalize and amortize the expenses associated with that. Well, the One Big Beautiful Bill Act has removed that requirement to capitalize those expenses. So now you're not only getting the ability to deduct the expenses associated with that, you can also then now claim the credit and really get kind of the full maximum benefit of that. So I think there's more reason to pursue this if you're a contractor because you don't have that, the kind of conflicting requirements there of capitalization as it relates to the expenses related to R&D activities.
You said that in order to qualify for that, though, there has to be like some type of research, not research, but a inspection or whatever, an audit. Is that right?
Yes. So typically my recommendation would be if I had a client that said, hey, I think I might want to look into an R&D tax credit, I would refer them to a specialist firm that specializes in doing research and development tax credit studies. And essentially what they're going to do is they're going to come in, do sort of a preliminary review of the different types of activities that you're engaged in, zero in on the activities that would qualify for this credit, and then they're going to help you track the costs associated with that. So for most businesses, it's going to be wages. So if you're a contractor that has like an engineer on staff, and again, they're doing, kind of like energy efficiency, like evaluations, or, they're doing like process improvement type activities, like their wages are likely going to count towards this credit. So they're going to help you quantify the different costs that are eligible. And that's what the credit is based on. It's based on the costs that go into the R&D activities. So they're going to help you, interview employees, quantify the hours that go into it. It ultimately leads to the quantification of the credit.
Gotcha. So this is really applying to companies that are doing significant amount of revenue, probably have lots of employees where they're working on that, because there's going to be costs occur just for having the inspection done, right? For doing the... Correct.
There will be a fee associated with that. The example I gave, they're a $200 million contractor, but I've worked with contractors doing, probably $10 million that this was still very valuable to them. They were still able to generate multiple 5 figures of credits. So you don't necessarily have to be huge to do it. I think, anybody that's in, maybe the $5+ million range, like there might be an opportunity there.
Okay. All right. That's good. All right. Let's talk about something that I think is, there's a funny element to this, but the termination of green initiatives. Let's dive into that. Cause what I see in the last couple of years, you've seen a lot of people buying cyber trucks, and getting them wrapped for the wow effect. And I'm sure they were getting the credit with that as well, but is that going to go away with this?
Yeah. So a lot of the provisions within this bill are taxpayer favorable, but there are some benefits that are going away, and a lot of them are focused on sort of green initiatives. So there's a lot of this bill that I've told my clients to be patient with. There's a lot that we don't need to jump into action right away. There are a few provisions in here that if you want to take advantage of them, they are going away very soon. And one of them is the credit for buying an electric vehicle. So that credit is terminating after September 30th, 2025. So if you're somebody that's been on the fence about buying an electric vehicle, and that's something you're interested in doing, I would get out there and get moving on that purchase sooner rather than later, because after September 30th, that credit is no longer available.
How much is the credit?
I think it's for new vehicles around $7,500 now.
Okay. So that's a credit. So, you're going to get $7,500 off of your liabilities there.
Right. And I think in most cases now you can actually get it off the purchase price from the dealer. Like the dealer can issue you the credit at the time of purchase. So it used to be you had to claim the credit on your tax return. Now you may be able to get it right at the time of purchase at the dealership.
Oh, okay. It's almost like an instant rebate kind of thing.
Essentially, yeah.
Gotcha. Okay. So if you want to get those Tesla trucks, guys, you need to go out there and start buying them up. You're going to lose that.
It's gone.
That credit. All right. Let's move on. This is a big one. This is a real big one. No tax on overtime. Talk about that.
Yeah. Yeah. It's interesting. I'll be interested to see how it really all works out, because the caps that are in place may be misleading some individuals. So there is a cap out there on how much overtime you can exclude from taxation. If you're a single taxpayer, it's capped at $12,500. If you're married and you're married filing joint with your spouse, the limit is $25,000. So you're not going to necessarily be able to exclude all of your overtime. There is a cap in place. And furthermore, there is a income limit where if your income is too high, you will not be eligible to claim this deduction as well. So if you're a single taxpayer, the phase out starts at $150,000 of income. So I could see a situation where, if you're a master plumber, you may have income that exceeds $150,000. You may not be eligible for this exclusion. So it looks really good on paper. I think it is going to be really good for a lot of people, but there are some instances where you may be surprised that you don't actually get the benefit for this. The other thing that I think is important for people to realize is that it's not going to increase your paycheck throughout the year. What happens is the amount of overtime is reported on your W-2, and you claim that as a deduction on your tax return. So your employer is going to continue withholding on that overtime via your payroll withholdings throughout the year. What'll happen is you claim the deduction, and it'll increase your refund when you file your tax return. So you do have to wait to get those dollars until you file your tax return.
Okay. Interesting. I don't think a lot of people realize that. I've seen a lot of stuff on social media where they're like, hey, we're going to get more money, it's going to help out with bills and stuff. And it's like, no, not until they return.
Right. So yeah, it's one of those things that it looks really good on paper. It looks really good in social media. But when you kind of dig into the finer details, you start to find out, there are some complicating factors here. Again, we're not going to get the money right away if we make too much money. If you're a married couple and you have a high income, through your spouse or whatever, you may be phased out of it and not eligible for the deduction at all.
Right. At the end, it's still a benefit, right? Like you're still going to get more money back. Sure.
Yeah.
Give me every penny I can. Who wants to pay Uncle Sam?
No, there's a famous quote out there, and I'll probably butcher it here on the spot, but it essentially is nobody's obligated to pay more than they are by the law. You only need to pay the bare minimum by the law. And, the IRS is not out to trick anybody. Everybody talks about tax loopholes, this and that. They want you to do what is correct via the law. So whatever's out there, you should take advantage of it without feeling guilty, because it is the law. Nobody's trying to pull a fast one over on you. You need somebody to look out for those opportunities, because you got a business to run. You're not out there reading tax code and looking out for those opportunities yourself.
Yeah, you see this all the time where, people want to blame the rich and corporations and they don't pay taxes and all that. And I love the response I think Trump had. I think it was during his first election, the primaries, they were talking about not paying taxes. And he was like, look, I just took advantage of the taxes that are on the books. If you don't want me to do that, then change the tax law.
Totally. I view my role as kind of a messenger. So if I tell you that you owe taxes, don't shoot the messenger. Call your congressperson and explain to them, why the tax laws should be changed. My job is to just ensure that you're paying the bare minimum as required by law. But sometimes the law is what it is, and everybody's going to pay tax sooner or later. So we just do our best to minimize that.
Right. Let's kind of jump back a little bit. And I just want to, for those that are listening to this, and, there's different listener base, some of them that are just starting out, some of them that are been in business for 20 years. I just want to kind of leave everybody with some main points here. If they're not using a tax person, they're doing it themselves, or they're hiring, some random person in their family. What is it that you would want to tell them as far as why they should hire a professional? What is the main points they need to consider?
Yeah, I think that we're seeing a big shift in all facets of our life to, specializations. Your general practitioner doctor, if you, God forbid, get cancer, your general practitioner doctor is not the person that treats your cancer. They're not the person that does, your heart surgery. So I think, thinking about your business as something that's not as important as your health, but pretty important for most people. And I would venture to say in construction, some people may prioritize their business over their health. At least I've seen that throughout my career in some cases. And again, I will stress, I don't think taxes are as important as your health, but I think you should take this very seriously. This is your livelihood as an entrepreneur. Taxes are going to be one of the things that you spend the most money on throughout your life. And so hiring an expert to help you out, you shouldn't necessarily view it as an expense. I think you have to view it as an investment.
That's true.
And not an expense. So it's something that if you're hiring an expert, you're working with them proactively, they're going to pay for themselves maybe, tenfold, 20-fold. I think in certain cases, I've been able to work with clients and save them 7 figures of taxes, 100-fold versus what their investment was. So, I think that it's one of those things that it's going to be a significant chunk of change that you're spending every year. You want somebody looking out for you. You want somebody that's proactive. You want somebody that's gonna, be there when times are good and when times are not so good. I think regardless of economic conditions, where things are at, a good professional on your side when it comes to financial advice is always going to pay for themselves.
I couldn't agree more with you. I think in the next decade, my wife is she works in higher education, and she's chair of a program at a university, and the whole college university debate of costs, and I think there's going to be a shift over the next decade where, like you were saying, you don't need to go have a 7-year program to become a generalist in medical. If you want to go on to be a specialist in one area, some of that stuff's probably going to get cut out, right? You don't need to have a 4-year degree when really it's only about 2 years worth of classes that apply to your actual degree. The other 2 years is just, for the university to make money kind of thing.
Right.
So a lot of that's is going to be changed. And I say that because you want a specialist, and it makes sense that you can with your taxes and your accounting, you need to have a specialist. And I tell my clients all the time, like, a lot of them have accountants or CPAs or people that are helping them. But they're not, I say, hey, whenever I bring on a new client, I'm like, hey, send me over your P&Ls. I want to look at your, see what you're doing in your business. Oh, well, I don't have, my accountant hasn't sent me over my P&Ls yet. I'm like, oh, you mean this month? Oh, no, not this year. They're about 3 or 4 months behind.
Yeah.
And I'm just like, what are you doing then? Like, yes, I know you think that it's covered because you have someone, quote, doing that job. But are they actually looking out for you and, making sure that you're staying the path, right? And so a lot of guys view that relationship as a transactional relationship and I'm sure you would agree with this, is that it's more of a strategic partnership. I mean, it's in your best interest to make sure your clients are, getting the best help and the best advice so that they continue to hire you long term.
Yeah.
Right. And so I'm just agreeing with you, like this whole, hiring a specialist. And I always say, like, if you're going to hire an accountant or a CPA or somebody, a bookkeeper, you really need to find someone who specializes in construction. You don't want the mom and pop that does, doctors and bakers and all these different, oh yeah, I work with small businesses, but their whole portfolio is like 30 different businesses. Right. I'm like, find the person that specializes with construction, because there's always nuanced things. Every industry has nuanced things when it comes to tax law. And that's why you need to find someone who works with contractors. So I say all that to say, I agree with you 100%. You need to find a specialist to be on your strategic team.
Yeah. Yeah. I mean, I certainly don't want to, I don't want to speak negatively about my industry, but there's a lot going on within accounting right now. There is a lot of mergers and acquisitions happening. So there's a lot of small firms being bought out by bigger firms. And so that person that you worked with for, 20 plus years, they're on their way out the door. You're getting reassigned to somebody you have no relationship with. I hate to say it, but, as they acquire these other businesses, they're going to do a right sizing of clients. So they're going to be clients that don't fit their model and that they're not going to want to work with. And I'm seeing, small contractors that it's like, yeah, I haven't talked to my guy in 6 months. He doesn't respond to my emails. It's like, well, yeah, because you're not his biggest client. So he's not going to respond to you because he doesn't care if you leave. I think the statistic is that 75% of CPA license holders are at retirement age. So there's a big shift of just overall people exiting the profession. So it's getting difficult, I think, to find good help. And ultimately, just to kind of reiterate, finding somebody that's an expert in your industry is, I think, going to become more important over time.
Yeah, I mean, a CPA accountant is one of the main ones you need. You need a good attorney. You need a good accountant. You need a good insurance person, and you need a good baker, that you can work with. And these should all be part of your, strategic team for your business. And so I couldn't agree more with you. As we're wrapping this up here, is there any, parting wisdom you want to share with the listeners, something that you would think that they need to take away that maybe I missed or didn't ask you about?
I think, just the big thing is, take taxes seriously, take the financial side of your business seriously. Be proactive. If you're not getting the responses that you need, it's okay to leave and find somebody else to work with. But it's ultimately, you got to look out for yourself, right? I think all of us as service providers, we really care about our clients, but you need to be proactive and you need to find the person that cares about you. And if you're not working with that person, you got to take the initiative to move on and find something else. And, don't wait for the last minute. We're recording this in July now. We have a lot of time before the end of the year. If you find somebody that is proactive, they can do a lot of good for you before the end of the year. If you call in January, February, most of the writing is on the wall at that point. There may be a few things that we can tweak after the end of the year, but really you're going to get the biggest benefit by taking it seriously and getting in touch with somebody before the end of the year, giving them all the information that you have about your business, your investments, everything that you have going on, and working with them to create just an overall tax strategy that we have, significant time to implement before the calendar flips over to January.
Awesome. I always like to ask all my guests this question, and then obviously your book, Laying the Foundations, is one that we can put in the show notes. But besides your book, what is a book that you are currently reading or one that you would recommend?
Oh, good question. I read quite a few last year, and I'm trying to think which ones really jumped out to me. I guess I'll point to back here. I will stack if I don't know if there'll be video of the podcast. If you're listening to the audio, I guess obviously you'll see this, but I have a couple books on traction and EOS. If you're not familiar with that, it is like a system for running your business. They call it the Entrepreneurial Operating System, EOS. I think that, and whether or not you use EOS or there's some other models out there, but I think especially as you start to grow your business beyond like a solopreneurship, having some sort of structure is huge. And I'm a solopreneur right now. I'm working on, growing this business and building out a team. I use principles of EOS as a one-man band, and it's critical for me. It helps me stay accountable to, just sort of my overall goals and distilling those goals down into sort of 90-day action items. I think I would recommend it. There's a whole series of books related to it. The Rocket Fuel one is great. Traction is a dry read. It's hard to get through because it's very much like a textbook. But Rocket Fuel is, kind of, what do they call it? A parable. It's like a story. I think that's a nice quick read. And, anybody that's, maybe has any sort of struggles with their business, I think looking into something like EOS could be huge.
Absolutely. I'm actually currently reading Rocket Fuel. I'm almost all the way through it. So that's a really good book. Awesome. Well, Cody, thank you so much for being on the show.
Yeah, thank you, Brad.
If somebody wants to learn more about your business or get in touch with you, what is the best way to do that?
Yeah, so pretty active on LinkedIn if you're using that. Otherwise, I would say just check out our website, builderstaxgroup.com. We have plastered all over the website links to, kind of fill out a quick questionnaire to get in contact with us. I'll do, free sort of tax strategy discovery calls with clients. So anybody that, wants a second opinion on anything, happy to jump on a 30-minute call, no charge for that. Just kind of quick run through of your, tax and accounting situation. Give you some tips and tricks. If everything looks great, I'm going to tell you that too. If you're working with somebody that really knows their stuff and is doing a great job, I'm happy to tell you stick with them. So obviously no pressure, but check out the website. The button's everywhere, and happy to jump on a call with anybody.
Awesome. Thank you so much. We'll put all the links in the show notes. So if you guys want to learn more about Cody and his business and how he helps contractors, go check him out. And guys, thank you for hanging out with us today. You know where to find me on the social medias. You can just search for the Hammer and Grind podcast or go to the show notes. And remember, until next time, profit is not a dirty word.